Hi everyone, this is Jason Burack of Wall Street for Main Street. I just wanted to do a short video today talking about the correction in gold and silver and gold stocks. And I want to show you the differing opinions between people with their articles, especially with technical analysis traders. You know, they use different indicators. They use, it's subjective. These guys act like they know everything. They act like it's not subjective technical analysis, but it is very subjective. If you look at 10 different charting guys, the work of them, you'd get a lot of different conclusions because they weigh different indicators differently, different chart patterns differently, different support and resistance levels differently, etc., etc. So I was looking through Twitter for people who have a lot of Twitter followers for stock traders. This guy is Chris Kimball, and he's talking about gold mining stocks, most dangerous time to own them in years, talking about the GDX, breaking support with most momentum overbought since 2011 highs. He also has another article out from last week about gold 2/3 odds, prices fall and support break. Maybe he did get the correction quite a bit, and he's talking about the uptrend. I will put the links to these articles in there for you to see the differing. I have other traders too, like Peter Brandt, who says, any wonder gold has stopped going up? And he's saying he's using mockery research in Bloomberg, which is mainstream. And he's talking about it showing physical demand is dropping. It's ridiculous. There's no inclusion there of the Shanghai Gold Exchange whatsoever. And then the other chart he's showing why gold has stopped going up. Part 2, there is no one left to buy it. Just ridiculous. And he's talking about on the CFTC net positions. Well, you know, obviously there's the LBMA, there's the over-the-counter market, there's the Shanghai Gold Exchange. And these guys, you know, they have 34,000 followers on Twitter, which for a stock trader is a freaking lot. And these guys have been trading for decades. So these guys act, you know, look at all the retweets he gets. I don't get anywhere near that amount. So I don't know, maybe he paid bots or something like that. But it's just, you know, the stuff these guys put out is very, very subjective. They look at one or two things and say, boom, I'm right. But what I would say, guys, is that a lot of these guys totally missed the move in gold and silver rallying and gold and silver stocks having the big move. Gold stocks have been the biggest performers in 2016. I want to show you for my subjective comparison to show you that depending upon which chart guy you look at, you get a totally different conclusion. I want to Tom McClellan here. This guy is very well respected in stock trading. Jim Paplava has him on a lot. He's very well respected for a trader. He looks at a lot of different things. What he is saying is that gold is going to have another painful correction probably sometime the rest of the year, and that'll be the final bottom. I'll put the link to the article so you guys can read it. But his chart work and cycle work is saying that gold is going to have a painful correction the rest of the year, and then by the end of the year, there's going to be an enormous rally. So I'll put a link to that too. But I want to give you guys some perspective here. I'll look at the charts myself briefly. This is the year-to-date chart. So, you know, look, early 2016 in January, we had like a pretty bottom here, and we've gone up, and then we've given back a little bit. And these guys are saying, you know, how overbought gold is, blah, 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 and gold stocks are. Okay, well, let's put things in perspective. Okay, this is the one-year chart. So, you know, we kept going down. We tried to make a bottom along these time frames here, and just couldn't. Kept going, bottom bouncing. Look, put in a spike low there. That's a pretty strong spike low. It's a strong V or a cup with a handle, depending upon how you want to, you know, look at it. That's a, you know, ugly looking cup, but it's still technically a cup. And in the handle, and boom, off to the races. There we go. And, you know, nothing goes straight up. So people who did buy here with the cup with the handle and they've ridden it up, some people are not as long-term as we are, and they've taken some profits. And, you know, taking some profits is not always a bad thing. So that's the one-year chart. Let's look at the two-year chart. You know, the two-year chart's more pronounced on how low gold stocks. This is the GDX, by the way, guys, which is one of the larger gold stock ETFs. So, you know, look, bottom bouncing there, a nice strong rally, and, you know, there's some support levels along the way here, so there's no guarantee that the gold stocks are going to crash back down like some of these alarmist articles are predicting at. So 5-year chart, you know, in relative terms here, the 5-year chart, you know, the gold stocks have had a very tiny rally compared to how high they were in 2011. Yeah, look at that. Look at that. Look at how much higher the gold stocks were, 62-ish. I believe as high as 65, almost 66 on the GDX. And we're still only at 25. And we have people saying gold's so massively overbought and gold stocks are, going to crash again. It's one of the most dangerous times in years to be owning gold stocks. And yet, on the GDX, it's very low compared to 2011. So, this is just how the you got to be careful about how many different about believing in just one trader. This is why the people who just believe in Harry Dent, or people who just believe in Bob Proctor, or people who just believe in Peter Schiff, they can get burned. So you got to kind of look at different experts there and weigh them and kind of look at their track records and see. I want to bring you guys another point I would add to about gold and gold stocks. One of the guys saying gold's the most overbought, and then he's quoting CFTC data. Let's talk about what the real gold experts, people have studied the market for years, Eric Sprott and others, they say with their research that gold is less than 1% owned by money managers globally. So we have a situation where a lot of physical gold is still being bought and accumulated, and yet a lot of people on Wall Street, a lot of people in the United States and developed world, they don't own any physical gold or physical silver. And yet here we have people saying it's overbought. So there are a lot of Wall Street people who missed the move on gold and were waiting for a dip. And I think they're going to start coming back into gold stocks and silver stocks and maybe buy some unfortunately, I think they're going to put money into ETFs because it's just easier. So like the SLV and the GLD. Obviously, that's not the right way to go. I want to show you, though, this is an article from Dollar Collapse. Good work by John Rubino. He was a guest by Mo, interviewed him last week. Always like John's work. But I'll put a link to this article up. And he's talking about how Chinese-backed gold miners, thanks to the money that China's printed, they're scouring the globe now looking for acquisitions. So, you can read about this, but basically now China has accumulated a lot of physical gold, as we all know, and central bankers, global central banks, are now net buyers the last year or two of physical gold, which has been the case. This is only the case for the first time in decades, although stupid Venezuela, because they're a socialist disaster, the Chavistas and the Maduros are dumping their physical gold the last 2 years. So that's really dumb. But I guess when you're broke, you sell what you can to survive, and they're trying to, keep that stupid government alive. But and they are on the verge of collapse. Largest one of the largest oil reserves in the world, and yet they have electricity shortages. More proof socialism doesn't work. And yet, the Bernie Sanders people who were endorsing socialism will still try it. Anyways, though, guys, off topic. I think the Chinese gold miners are going to look to go buy a lot of physical gold assets. We saw them make a bid for one of Glencore's largest gold miners, and I think, there's going to be a lot more. The prudent mid-tier gold mining companies that haven't done an acquisition yet, they're definitely going to be on the prowl. These guys have better balance sheets than a lot of the senior gold producers who did stupid acquisitions and used debt improperly. But even the larger senior miners now, they're looking to do private placements now for exploration. We saw Luna Gold, which was an incredibly mismanaged producer. They actually have a really awesome asset in Brazil, and they've had more than 5 CEOs in the last 5 or 6 years. Totally mismanaged that company, basically almost went bankrupt. And yet AngloGold Ashanti, which is one of the largest gold miners in the world, they just did an interesting exploration deal around the greenfields exploration for Luna. So I think we're going to see more of those types of deals on the gold miners that are either already producing or about to restart producing, and some of the juniors. So we are starting to see good deal flow in the industry, and the sentiment is changing. And I think consolidation is good, because you want to see it really worries me, if you put a lot of money, even a speculation, into a smaller producer that's either bringing production online, even if the costs are low, because there's a lot of things that can go wrong with the mine. So, obviously, I think the sweet spot for investing in mining stocks is either, if you don't have the money to diversify, you should either buy these ETFs like the GDX, the GDXJ, the SILJ, which is the Junior Silver Miners ETF, or the Sprott Gold and Silver Miner ETFs. But, the individual companies, I think the mid-tier ones, if they have low costs and their balance sheet aren't riddled with too much debt, those are good, besides just the royalty and streaming companies. Those ones like, Keith Neumeyer's First Majestic Silver is now a senior silver producer, but Keith runs prudent companies. But there's a bunch of other ones. If you're interested, you can email wallstreetformainstreet@gmail.com. So I just wanted to do this video showing you that how subjective technical analysis can be. People weigh different cycles differently. They weigh different technical indicators differently. They look at chart patterns differently. And so I showed you a handful of different opinions on gold and gold stocks. But I think the bottom line is it's going to go to the fundamentals, just how incredibly stupidly undervalued the gold stocks were at one point. You know, we had, to give you guys some examples, we had gold mining companies and silver mining companies that had put in over $100 million worth of drilling and infrastructure into their mines, and either the mines weren't producing and had been temporarily shut down. And these things, you know, they were worth more dead than alive. So these things could have been bought by private equity companies, and their assets could have been chopped up and sold. And some of these companies had market caps at one point last year. Things were so bad, they had market caps of $10 and $20 million when over $100 million had been invested into the asset. So these things do have long-term value. Obviously, they weren't generating free cash flow at the time, but you know, one of the ways to make money as a resource stock investor, to buy and make money off resource stocks as a value investor, and obviously the Warren Buffett value investors aren't going to do this, but value investors in the past, like Sir John Templeton, who are not quite exactly the same type of value investor as Warren Buffett, and Benjamin Graham even did this. They will look for undervalued resource stocks where the company had the possibility of a turnaround, and the commodity price and the commodity price was below the industry average for cost. So obviously that's not sustainable. It could last a long time. You shouldn't put all your money into any one specific resource stocks or try to time things perfectly. But something like that was not sustainable, where you know the commodity price itself was going to stay way below the average all-in sustaining cost of production. So we haven't gotten that yet for commodities like copper. We have that now for uranium, where the uranium price is way below, the uranium spot market price is way below the average all-in sustaining cost of production for uranium, but some of the uranium miners have hedges. So, but that's not sustainable either. Those hedges will come off, and then we're going to have a situation where supply is going to have to shut down, and the market's going to have to, you know, get back to painful free market forces, and supply is going to have to come offline. And we've had this in gold and silver. So we've had a situation where a lot of exploration budgets were cut, mines that were going to come online, you know, 2011, 2012, 2013, those mines were delayed or shut down, and those projects were pushed back for years. So I don't think we're at a gold and silver price where a lot of new mine production is going to come online, especially with the crash in base metals. So thank you guys for watching this video. This is just my opinion on the correction for gold and silver stocks. You know, we could have it could be down a little bit more, but I think industry-wide there are mining companies that want to do acquisitions. There are Wall Street portfolio managers who totally missed the move in gold and gold stocks and silver, and they were looking for a dip to buy, and they are going to be putting money to work. And the people who are saying that there's no more money left to put into gold and silver, I think that's just ridiculous. I mean, I think they're only looking at one or two Wall Street indicators. Okay, bye for now.